Welcome back to Indianomics. This is a Citi India special. I've been speaking to the brains trust of Citi India, the head of markets, Aditya Bagree, and the head of equities, Surendra Goyal, on their upcoming Citi India conference and all the important themes that they will be discussing there. Thank you very much, Aditya and Surendra, for dropping into our studios in the first place and for your patience. Okay, Aditya, you said that you see Indian bond yields going to 6.8, but can the Fed spoil the picture? Quarter after quarter, the growth over there is better than what the economists forecast, and better by like 1 percentage point, much like our country. So do you think the Fed moves can be pushed out into 2024?
It's a very good question, Latha. I mean, I think the question that everyone is asking, whether US is going to be able to achieve a soft landing, or whether it is,
that is good for rephrasing the question, yes.
Right, or whether it is going to be a hard landing. To be fair, I agree. I think the recent data has been stronger than what the market was expecting, but we think you will start seeing some cool off on the data going forward. From the Fed, the inflation number that Fed normally focuses on is core PCE, right, which has gone down all the way to 1.9%, has come up to around 2.5%. I think it does give room to Fed because the real rate, even comparing 2.5% inflation, is 300 basis points, which is quite high. But I think the number that they will be focused on is more employment or non-farm payroll, right? So if that starts cooling down and if that leads to growth coming off, I think Fed will get some room to start cutting rates. Okay. Even if you look at from a markets perspective, right? I mean, if you look at the last Fed dot plot, I mean, they had projected only about 75 basis points of rate cut. The markets was actually projecting a lot more, but they have readjusted, and now market is pricing in only about 100 basis points of rate cut this year. So not a big difference.
Yeah, at the most, the disappointment may be another 25.
Exactly.
But Aditya, what are the chances that the yield, the 10-year yield doesn't oblige? Because the fiscal deficit, if you extrapolate from the October, November, December quarter, is still very high in the US. The issue of treasuries may still be very big. So how do you see the US 10-year behaving? And if it goes towards the 4.2 or 4.5 mark, even then our yields can fall?
See, I don't think that's our base case scenario. I mean, and we have seen some of the correction already happen, right? The 10-year yield went up all the way to 4.4. Yes. Now it's come back down to 4.2. Our base case is it will come back down to around 3.9 kind of a level. We also think from a reaction perspective, markets will react more favorably to softer data than to more hawkish data going forward. So there's a better chance that if the employment number or the NFP, which is expected this week, I think last number was 350,000 new jobs. We are actually expecting it to come off significantly closer to like 150,000 new jobs being added. And if something like that happens, we think yields can fall in US.
Okay. Well, I wanted to ask you about how you look at financials, therefore. If the Indian yields are coming down, how do you look at banks and NBFCs? Is that a favored sector?
Yeah, so I think you have to look at everything together, right? Where valuations in that sector are is also an important parameter to look at from a stocks perspective. So near term, the business outlook is definitely a bit muted, no doubt about it. But when you look at all the large sectors in India, they are trading well above their historical levels as far as valuations are concerned, right? While financials as a sector is at or below the median kind of level, right? And if you are kind of thinking about it slightly longer term, it's very difficult to have a situation where the economy keeps on doing so well and financials kind of keep on struggling. So our view is that this is a good chance to add some of these names, right? Particularly on the private banking side. These are businesses which have compounded very nicely over the years. And this is one of those opportunities where for people with a medium-term time frame, this is just a chance to add exposure to that sector.
Well, the other thing is, speaking about soft landing and the US growth surprising on the upside, how are you looking at IT companies? Surendra, actually, I remember you first in your IT analyst avatar. Some people have already started calling a sell, saying that some of the stocks have gotten too pricey. Your view?
So we turned cautious more than a couple of years back. And since then, we have not yet turned positive.
Okay.
I think it's a combination of lot of things. See, firstly, I think you pointed out that last year's growth in the US surprised, right? But if you look at the IT services companies in India, the growth at the start of the year, people were expecting high single digits. If we are ending the year closer to, say, 3%, even at an industry level, if you take the top 10 companies. So clearly there has been a negative surprise. And what is that coming from? That's coming from uncertainty in decision making, right? So while the macro data has been positive, corporates are still very cautious because there is a lot of uncertainty. So on the discretionary spending side, you are seeing a lot of caution, right? Now, as we go forward from here, it still looks like a slow recovery. I think the macro uncertainty has to ease. We really need to see a path of clarity that, okay, this is what the macro is going to look like, right? And if you look at the macro data, 2 weeks you feel that, yeah, things are trending in this direction, and the next 2 weeks it's on the other side. So I think that clarity needs to emerge, and we are also cautious about a couple of other headwinds. Okay, see, firstly, global capability centers, or GCCs as they are commonly called, you are seeing a lot of growth there.
Stiff competition too.
Yeah, so again, like while clients do demarcate the spending, but to us it definitely feels like GCCs are playing in the part of the spending which is seeing better growth. Okay, so that's point one. And secondly, the industry just keeps on getting more and more fragmented. So if you compare, say, 6-7 years back, a lot of the smaller players today were not relevant when it came to, say, $25-50 million deals. So when you put it all together, it's still a challenging backdrop, and that kind of explains our underweight stance on the sector.
Actually, speaking about your entire year's target also, you said some good weeks, some bad weeks. 22,500 is your, end of year target.
That's right.
But you expect an overshoot, I mean, when, say, election results come or in the run-up to the election results?
Yeah, so see, that could always happen. The only point I would make is, see, the market did capture a fair bit of upside post the straight election results end of last year, right? Today, where we sit, everything is looking quite decent, be it the economic growth, earnings growth, financialization
difficult to find
of
the
savings.
negative picture.
The only thing I would still be careful about is the valuations are also pricing in a lot of these positives, right? When you look at market at 20 times earnings at a 90% premium to other emerging markets, then you really want to see at least either earnings surprising on the upside, or else if you just think about it, right, since the start of this year, the market is up 2%, right, despite all the positives. Right. So you could just have a period of consolidation, and then people get more comfortable. We could easily go through that phase. Okay. So that's how we are really thinking about
what kind of earnings growth are you expecting in FY25 itself?
Yeah, 25 is more in the range of 14%. Actually, 25, 26, if you take those 2 years, we are in the 13-14% kind of CAGR band, which is pretty healthy going by the past standards.
Oh yes, the past decade,
we were at high single digit or thereabouts, right? So in that context, it's still very healthy. But it feels like that valuations are at the higher end and they need to moderate a little bit for better entry points. Okay. And again, so our view is that firstly, buy any dips. And secondly, there are opportunities in a market which where at a headline level, there may not be a lot of upside. So that's how
certainly, as you pointed out in the private banks, where you said that you will buy the dip. Well, a final question to you. I know we get carried away in equity markets. Aren't the debt markets in for some very interesting times? I mean, if so much of foreign money comes in, some 40 billion or 30 billion, there will be more hedging activity. The Reserve Bank also is pushing banks, away from, relaxed views into, accounting standards where they have to hedge more. So do you think the debt market has a lot of legs to run in terms of volume, sophistication?
I think it's already happening, Latha. To be fair, I think the debt markets in India, if you look at the spreads at which the bid-offer spreads at the trade, I think it's one of the tightest in the world, right? So from a liquidity perspective, I actually find Indian debt markets to be decently liquid. And I agree, I think with more foreign money and foreign interest starts coming in, we normally see that there are certain on-the-run bonds that tends to perform very well, while the other off-the-run bonds stop trading after some time, right? But with all of them getting included in the FAR bonds, and there will be continuous interest from foreign investors to keep buying these bonds as they rebalance, right? So we definitely see a lot more liquidity in the market at the back of it. Also, I think the domestic institutional investors have kept getting larger and larger,
Yes,
right?
insurance, pension.
Exactly, right? I mean, so earlier, I think a large part of the total government bond issuance was subscribed by banks, and they used to hold it as part of their SLR portfolio. But we actually see insurance and pensions becoming a big part of the total market and taking up a lot of duration, especially the 30, 40, 50-year bonds. That all shows how the bond market has been developing. So I actually see one way for the bond markets to go from here.
That's very important even for the lay investor. Debt mutual funds went into a dip when the tax advantage was taken away. But I would urge all of you to listen to what Aditya is telling us, that 6.8 on the 10-year Government of India bond will mean that there is a lot of legs to run even for corporate bond, and therefore for bond mutual funds. Of course, equities is a game that everyone knows, and as Surendra says, even if the end of the year is going to be 20,500, there could be overshoots through the year. Thank you very much, Surendra and Aditya, for dropping by, and I hope you have a great conference.
Thank you, Latha.
Thank you.